Hello class, this is week 2. I wanted to talk to you about accrual accounting today. There's 2 ways to do accounting. One is cash basis accounting, and in that method you only record transactions when cash changes hands. Now that works fine for a small business, but it doesn't provide very good information if you're an investor. So most publicly traded companies have to use accrual accounting. In fact, if you are incorporated in the United States and you want to take out a loan, you're going to be required to use accrual accounting in your financial statements. Primarily, it just gives better information. So the definition for it is the recognition of transactions when either revenue is earned, expenses are incurred, or purchases take place. And it does not require you to exchange cash at that particular moment. So I have a video here that I'm not going to play the video, I'm going to walk you through it, that kind of shows the difference between cash basis accounting and accrual basis accounting. So let me just key it up here.
So one of the main
All right. So let me go to a full screen here. And what you see in front of you is basically some accounting transactions for a catering company. And that catering company has both cash basis and accrual basis transactions here. So if you look at it, in the first column for month 1, these are cash basis transactions. In the second column for month 1, these are accrual basis. So you have 4 months being presented here. Now, up above, you have what transactions are taking place. And in the first month, what it's telling you is that your catering company caters an event. Your cost is $100 for the food and so forth, and your client pays you $200. So very simply, cash basis. You got $200 in, so you have sales of $200. You have expenses of $100, which means you're showing a profit of $100. Accrual basis accounting is exactly the same for the first month. And you can see you have $100 in your cash account. In month 2, though, things are going to change. In month 2, you have a bigger event that you're catering, and your cost is $200. And the customer is potentially a good customer, and you tell them that the $400 fee for catering the event, they can actually pay you in 30 days. Okay, so they're going to pay you in month 3. So cash basis accounting in month 2, you can see we have no sales whatsoever, but we have a cost of $200, so it looks like we lost $200. And our bank account is now overdrawn by $100. Under accrual-based accounting, we record a sale for $400 even though we haven't received the cash yet. We did do the event, therefore we need to record the sale. You can see we have a cost of $200, so it looks like we made a profit of $200. My bank account is also overdrawn by $100, but if you look down below here, you can see I have $400 sitting in the account called accounts receivable. That's where I record transactions for people that owe me money. Okay, so we go to month 3, and you can see the narrative up here. In month 3, that customer that owed me $400 paid me, and I have another customer that's putting a deposit down for me to do an event in month 4. So I basically got $600 in. So using month 3, cash basis accounting, you can see it's showing sales of $600. There's no cost because we did no event. So in cash basis accounting, it makes it look like we had a profit of $600. We deposit the money in our account. You can see we have $500 here. Under accrual basis accounting, we have no sale and we have no cost, and that's because we had no transaction. We got the $600, we put it in our bank account, and you'll notice that the $400 receivable is now 0. So we gave the customer credit for having paid us. But I now have another $200 that a customer has given to me to hold an event in month 4. So we have put this in this example in an account called deferred revenue. You could also use customer deposit. It's a liability account, and it's a liability account because you owe the customer the catering event. So I got $600. I put it in the bank. It took my account from negative $100 to a positive $500. I got rid of the accounts receivable, and I now have a liability for $200, which brings us to month 4. In month 4, you cater that last event, the one the customer's already paid you for. So under cash basis accounting, there's no sale because no cash came in, but you spent $100 on food and payroll, so it looks like you lost money. And you can see your bank account went from 500 to 400. Under accrual-based accounting, though, you have a sale of $200 because your customer paid you ahead of time, and now you've done the event, so it represents revenue for you. Your cost is $100, so it looks like you made a profit of $100, and your bank account is $400 as well. So if we were to look at this on cash basis only, we can look at this and we say, okay, in month 1, we made a profit. In month 2, we lost money. In month 3, we had a big profit. In month 4, we lost money. So in theory, you could argue that 50% of the time this company does an event, they lose money. That doesn't sound very attractive. Under accrual accounting, month 1, we do an event, we make a profit. Month 2, we do an event, we make a profit. Month 3, we have no profit, we have no loss because we did no event. And in month 4, we cater the event and we make a profit. So one could reasonably argue that 100% of the time when the company creates a catering event, they make a profit. Okay, that's outstanding. Okay, so think about it this way. If we go back to the keynote for a moment, before we talk about deferral accounting, here's an example of why this is important besides the catering company. Let's pretend for a moment that you're thinking about investing in a company, and you look on their financial statements and you see they have $1 million in cash and they have no liabilities. So it looks basically that they got $1 million they can use whatever way they want. So that intrigues you and you decide to go ahead and buy stock in the company. The very next day after you buy the stock, the company then pays a consulting bill for $1 million. And so as a consequence, the company doesn't have $1 million. In fact, it has no cash at all. So if the company had been using accrual accounting instead of cash-based accounting, they would have recorded the liability at the time they got the bill. And you could have looked on the balance sheet and said, yes, they have $1 million in their bank account, but they also have this big consulting bill that they were going to have to pay. And that may have changed my decision on whether or not to invest in the company's stock. Now, the opposite of accrual accounting is deferral accounting. And in deferral accounting, you are going to recognize a revenue or expense, basically not at the time you get the cash, but at some point later on. It could be over several accounting periods. The common examples given are prepaid rent, depreciation, and supplies. In prepaid rent, sometimes you have extra cash. Excuse me. You have extra cash, and you have an opportunity to do something with that cash. So you go to the commercial bank and you say, I want to open a bank account. And they tell you, okay, basically we can pay you 1% interest. So that's not a very good rate of return. However, you talk to your landlord and you said, look, if I pay the whole year's worth of rent up front, what type of discount can you give me? So the landlord says, I'll give you a 5% discount. So you basically made 5% by prepaying your rent versus making 1% by opening a bank account. So that's why you need to be careful on, opportunities like that. Using the rent example, we have a case where let's use $1,000 a month as our rent, and we're going to pay the landlord $12,000. So your transaction would be to credit your cash account to reduce it, and then you would think that your debit is going to go to rent expense. All right, well, if we do that, what's going to happen in month 2? In month 2, we have no rent expense because we've already expensed the $12,000. We have no outflow of cash because we've already paid it. So it looks like we have no rent at all in month 2 through 12. However, in month 1, it looks like we're paying $12,000 a month in rent. So that's not very good information. However, if we had used the deferral accounting, then what would happen is we would have credited our cash account for $12,000, and we would have debited an asset account called prepaid rent. Each month, at the end of the month, we would do a journal entry to reduce our asset, prepaid rent, by $1,000, and to turn around and expense $1,000 in rent expense. So as you're looking at my profit and loss statement, you'll see each month I have rent expense of $1,000. Same thing with depreciation. When you buy a fixed asset like a vehicle, then you're allowed to spread the cost of that vehicle out over the useful life of the vehicle. Now that helps your profit and loss statement, but it also more correctly shows what type of an expense is incurring by the use of that vehicle on a month-to-month basis. Okay, supplies, same thing. Now, this week's assignment, you have 15 transactions you're going to have to record in QuickBooks. And they're going to be a combination of transactions. There's going to be some journal entries, like the one that was done in assignment 1. You're going to have some customer transactions, and you're going to have some vendor transactions. My recommendation to you is to make sure for assignment 2 that you read through all 15 transactions before you start to work on it. If you do that, you'll find that there's some transactions early on that are connected to transactions later on. So if you get a good feel for what transactions are coming up, it'll make things infinitely easier. As usual, attached to the assignment, there's videos. There's also an archived version of the week 2 go-to training that's listed in the first section on the FSO platform. You're welcome to look at those. Your version of QuickBooks may be different than what's in the videos, in which case, depending on the version you have, you should go to YouTube. You should do a search on QuickBooks, online version, and then whatever the specific topic is, such as customer transactions or vendor transactions. And that will help you immensely. Okay, I hope you enjoyed this brief overview of accrual and deferral accounting. And if you have any questions, as usual, please feel free to contact me.